Well, good morning. Well, it's now afternoon, everyone, and we have a few folks joining. And again, we always tape these, put them up on the website, so in case anybody wants to view these later. So anyway, here we are. It's March already, and nice and hot in East Texas as it has been. It's kind of strange. Everything's blooming and beautiful. So I don't know. Well, let's jump into this. We have a lot of questions, especially from viewer clients or people whose businesses have grown. Is should I change my legal formation? Am I organized the best way to protect myself legally and from liability issues? Am I structured the best way to get the best tax benefit? So I want to just give an introduction and some of the common legal structures for small businesses and kind of go through those. So our agenda for today, we'll talk about 4 common structures and really 5 when we add limited partnerships into the partnership portion. Talk about the advantages of LLCs in Texas, the formation process in Texas, so it's different for different states, and S elections, pros and cons, and then some special topics we'll dig into, and then any Q&A. And I also, as always, I encourage speak up anytime. I love it being interactive. So if you got a question or a comment, please jump in at any time, and we'll try and I think quite a bit of info here. And again, this is an introduction. A lot of times things are very complicated with tax and legal issues, so I'm just trying to jump in and introduce the basics. So the most common and the simplest is a sole proprietorship. And if you've ever had a Schedule C on a tax return, this is really what you have. You've decided to go into business doing something and just jumped in. Well, you've got a sole proprietorship. And as you can see by the form here, that is reported under the owner's Social Security number, even if you might have an EIN. And the earnings from this flow through, and you will pay income tax on them, and you'll pay self-employment tax, which is Social Security and Medicare. So that accrues to your account, whoever the owner is, the single owner of this sole proprietorship. Again, there are no filing requirements. You don't have to do anything to form this. You just basically go in business. You can use your personal checking account. You're just responsible to report income you earn and the expenses related to it on this Schedule C. And again, it's reported under the owner's Social Security number, but I really recommend everybody, if you're just going to stay using sole proprietorship, get an EIN. You can go to irs.gov and you get an employer identification number. You have to have that if you have employees, but at least you would then get a bank account under this EIN. If you had to report 1099s, it's under this EIN. So your own personal Social Security number isn't blasted out everywhere. So that's a quick tip there. But again, this profit that flows through, the difference between revenue or income and all your expenses, the bottom line is subject to both income tax and self-employment tax. And to refresh, again, self-employment tax is roughly 15% of that profit. It's 15% up to about $160,000, and then the Medicare portion goes on about 4%, goes on pretty much forever. So that again is Social Security and Medicare. And if you're working for somebody, they're going to take out 7.65 and they're going to match it, and they're going to send in this 15.3. So like I say, I quip that when you're self-unemployed, you get to pay all of that yourself. So it's important to know those things. If you want to operate under a business name, as you can see here, you want a different business name, you have branding, then what you should do is go to the local courthouses where you're going to be operating and file a doing business as, sometimes they're called an assumed name. And there's just a simple certificate. I think it's around here, equipment, and maybe $15 to file for this. Many people don't do this. I mean, this has nothing to do with trademark protection or anything else. I mean, if you want to call yourself Walmart, you might get away with it for a little while, but eventually their lawyers will find you. The thing about a sole proprietorship, there's absolutely zero liability protection. So let's say if you've got a landscaping business and you then get some contractors and maybe even employees working under you, and you have some assets built up inside this sole proprietorship, and an unfortunate accident happens. Well, that means that if there was a liability issue, your personal assets are also at risk. Anything you as the owner have complete liability, and all of your assets, including your personal residence or whatever else is protected under law, uh, may be subject to a claim. So that is a problem for businesses that have risk, that have the risk that there might be a liability issue. All right, another form of entity is when two people decide to get together, two or more, and say, let's do a business together. And there's a misunderstanding here that if we just have a joint venture, we're just kind of sharing income and expenses and this and that. It doesn't matter. You have formed a partnership, and you are responsible for filing a partnership return. And this is called a general partnership. And the thing about a general partnership is there are no formal filing requirements. You don't have to tell Texas that you've got a partnership. You just kind of pool your resources, and you may set up a different a business banking account in the name of it, or you may not. And then you've agreed to split the income and expenses, or split the profit, or whatever, or however you've decided to do it. You don't necessarily have to have a partnership agreement. You could have an oral agreement. But listen, my 2 cents on this after many, many years are that in business, partnerships, and when people get to, it's kind of like a marriage in some sense, and it's important to have an understanding. You're getting in together in business. And I say the best basis for trust, especially between friends and family and people that go to church together, is a well-written agreement. Because, we all get, our memory fades, or we forget about this and that, and sometimes when money's involved, it can get to be challenging and tricky. So the best way to be upfront and write it all down and have a good written agreement on how it's going to operate. But you don't have to. You can just have an agreement of how we're going to do things and split the money and pay the money, and it could work fine. But I've seen a lot of times when it doesn't. So that's my suggestion from decades of experience. So in a partnership itself, the partnership does not pay tax. The income and losses flow through. It's a flow-through entity. And so really this return is a reporting vehicle, and the partners get a K1, and on that K1 is their share of items of income and loss, capital gains, capital losses, broken down into the various components that go on an individual tax return. So it flows through. Now, another thing to realize is when you have a general partnership, your agreement notwithstanding, legally, each of the general partners can obligate the partnership. So if one partner goes out and decides to buy a very expensive piece of equipment, or a Maserati for the corporate car, and signs on behalf of the partnership, that partnership and the other general partners are liable. So that's one thing that's challenging about a general partnership, is that partners can obligate one another, the general partners can't. And the other thing is, again, in a general partnership, there is zero liability protection from the entity itself. There is no protection. So all of the personal assets of the partners can be accessed if there's a liability issue inside this partnership. So this isn't a very common form of ownership. Some other things about partnerships in general is the rules of partnerships, and I'm not going to get into it here, are very tricky and can be very complicated, especially if you have a partnership with one person. I'm going to put $100,000 in cash. I'm going to put in land worth $100,000. The basis issues, and the partnership will look at that as, okay, each partner put in $100,000. Where it's tricky is maybe that land was purchased for $20,000 by the partner, and it carries that same basis for him. So it begins to be tricky if it's sold or some other things happen. But inside, they have agreed, we've each put $100,000 in for $200,000 in capital. But the tax basis on this other one is only 20. So there's some complicated issues can come as a result of that. It's just a matter of good accounting and good tax work. So then people are concerned about the fact that, hey, I've got a partnership and everybody's liable. So you will see LPs, limited partnerships. And now we're getting into an area where you must file formation documents with Texas or the state, wherever it is. And it's a formal creating of an organization. Generally, with a limited partnership, one or more general partners manage the business. And those general partners typically have the unlimited liability, and they manage and run the business. And a lot of times, to get around that, you'll find that the general partners will form an LLC, and it will be the general partner for this. So there's some ways to get around that. But in general, just to talk about this. So these general partners run the business. They manage the business, and they have unlimited liability. You must have a partnership agreement in this case, and it's very important to spell out how the profits are going to be split up, et cetera, et cetera. Now, limited partners are considered passive investors, and they're only liable up to their investment. So if a person puts $10,000 into a limited partnership and something bad happens in there, the most they could be liable for is the $10,000 they put in. But limited partners generally have zero say in running the partnership. They are completely passive. It's an investment vehicle for them. It's not something they want to run. Now, when you have a limited partnership, and I should have said in a partnership as well, the profits that flow through in a general partnership are generally subject to that self-employment tax, just like on the sole proprietorship. The flow-through income to general partners is subject to self-employment tax in a limited partnership. But what flows through to the limited partners is considered passive income. It's not subject to self-employment tax, just income tax. And it also, again, is a passive investment. This is a passive investment that they don't materially involve themselves in and run. So it falls into some of the passive income and loss limitation rules that are a topic for another exciting topic, one that is just, you would be so, you would be so excited to hear about someday. So you'll find a lot of these limited partnerships, and you may see this every now and then. Films, movies do this. Oil and gas projects, you're going to have these limited partnerships that are formed and run. So a lot of real estate projects are formed this way. So that's an option, a limited partnership. Now the corporation, back in the day, when I was first practicing, it seemed like everybody wanted to form a corporation. And boy, it was exciting. You could get these big kits, and we've done a couple, and you get this thing, and it's got a stamp in there that makes it, you've got stock certificates, and you've got the forms, and it's in a big binder. So corporations, of course, we know that the AT&T, all these very major entities are, most of them probably corporations. There is limited liability. It requires a formal filing. But corporations become a different animal in that they're run by formal bylaws. And those bylaws are the rules of how that's going to work. And typically, it's got a very strict management structure. You've got shareholders who elect directors. Now, they may be the same people in a small, closely held. And those directors elect officers, president, secretary, treasurer, vice presidents, and then they have managers under them. So it's a very formal, a corporation is a formal approach towards organizing a business. And it has strict annual meeting and record keeping requirements. So you're bound then, you need to have minutes of meetings. You need to have records of the resolutions that you've passed and the decisions you made at a high level. And those need to be documented carefully and kept in some sort of a formal place, binder or online, whatever. Now, a corporation also is not a flow-through entity. It's not a flow-through entity. It's the only thing we're going to talk about today that is not. It pays income tax. Now, currently, the corporate income tax rate is 21%. There's no capital gains difference. It's just 21%. You can say, well, hey, that's fantastic, 21%. That's way less. If I'm making a bunch of money, I'm paying 35% tax rate individually. So let's just leave that money in the corporation. Well, here's the problem. Dividends that you've heard of double taxation. People say you want to avoid double taxation. Well, that's true. The money that comes out of a corporation in the form of a dividend is not deductible to the corporation. So money that the corporation has paid tax on at 21% is going to come through and be taxed to the shareholder as a dividend. And that's where you get double taxation. I paid tax on this profit once, now I got to pay tax on the dividend. Now, in a lot of cases, that dividend can be taxed at a favorable rate, and it may be 15% or 20%. But you still, at a worst case, you would end up paying 40% and more on those profits. 21% in the corporation, 20% and maybe more personally. So that's why a corporation is tricky. One of the benefits, the structure can outlive founders. It goes on and on. You've issued shares, and you have different people, the shareholders, and that have that stock can vote in new directors, and so it's a way more formal thing. But for small businesses, it's one that we just really don't recommend anymore. We don't find there's any compelling reason to go onto this level of formality for our small business clients. And especially because of the issue of double taxation, it's just tricky getting money out of a corporation. It's tricky. If somebody put a bunch of real estate inside a corporation and it appreciates over time and you want to take it out or sell it and take the money out, you've just got some issues. And there are ways to avoid that. And so one of the things that we really recommend is a limited liability company. And there is limited liability, just like a corporation has limited liability. I'll talk more about that in a little bit. I can pause for a minute because I'm not really seeing in the same way the setup we have. If anybody's got anything they want to say, please have at it. Don't let me just blather away and bore you to death. But there is limited liability. The thing that's beautiful about a limited liability company, you can have one owner. You can have one owner. And now you can have one owner of a corporation as well. But the difference is if you have one owner of a corporation, you've still got to file a corporate tax return, Form 1120. With a limited liability company that has one owner, one member, it's called a disregarded entity for tax filings. And so that means that you could file a Schedule C with your limited liability business on your personal tax return. You don't have that extra expense or administrative cost of filing a separate tax return. So it can be a disregarded entity. Now, limited liability companies are run by an operating agreement. Now, look, you can have very complex, and I've seen very complicated operating agreements, but you can also have a very simple one that basically, hey, I'm in charge and the decisions I make count, and we can't bring anybody else in without my written consent. And here's what happens if I pass it on, or we're going to shut it down. Boom, put that in a file, and that's it. No need for annual meetings, no need for anything else. You can always update or amend your operating agreement, but it's very simple to run. You can also choose to have it managed by the owners, one or more, or you can actually have non-owner managers. So that's a choice you make when you form it. And you can always change these choices later. You can amend these things. So it's got a lot of flexibility with a limited liability company. Another thing that's very easy with a limited liability company is you can easily assign different percentages for capital, profit, and loss sharing. So you can have somebody put in a bunch of money and they're going to have most of the capital, and they're also going to get more of the loss sharing than somebody else who doesn't need it. And then at some point, at some trigger, you may even it out, so they're going to share profits equally. Losses go to one. You just, unlimited creativity. You can have different classes of members, Class A, Class B, that get different returns. Tremendous amount of flexibility with a limited liability company. Now again, the flow-through income is generally subject to that self-employment tax, like a sole proprietorship or like a partnership. I mean, if that income would be subject to self-employment tax, it's going to be taxed that way. I mean, if it's rent income that isn't subject to that, it would retain that character. But the flow-through is subject to self-employment tax. And then if you have more than one owner, it does file a partnership return. So there is that, and each of the individual partners get the K-1s, and that's how they file what happened inside that partnership according to their ownership on a K-1 on their personal return. The other thing is that a limited liability can elect to be taxed as a corporation. It does not change the legal nature of that limited liability company in Texas and how it's run, But the IRS can then view it as a corporation and say, well, why would you want to do that? Well, we'll get to that in a second. So to recap a little bit, the advantages to an LLC, they're easy to run and form. You can have limited liability for one owner. You can have multiple classes of ownership, creative ways to allocate capital, profits, and losses, easy to move money in and out. And you can elect for the IRS to tax as a corporation to make an S election if you wanted to. So primarily our recommendation to folks is, look, in Texas, and you want liability protection, form an LLC. Form an LLC. It gives you the most flexibility, and it's the easiest to administer. Now, forming an LLC, some people think, hey, I want to save taxes, so I'm going to form an LLC. No, that just forming an LLC is not going to change the structure of your taxation one bit, especially if it's a single member LLC. It's as if you didn't do anything different on your taxes. So that sometimes people think, hey, I want to save some taxes and form an LLC. It doesn't work like that. How do you form these entities? Well, I mean, it's easy to do yourself. The Texas Secretary of State has a lot of instructions. You can find lawyers that will charge a lot of money to do it, and we can recommend some lawyers that will do it for very reasonable, few $100. It's $300 generally is the fee with Texas to form these different entities. And you'll notice the non-for-profit in here, that's a whole different animal and requires a different approach. So I'm not covering that today. But anyway, it's formed through the Texas Secretary of State. And when that happens, automatically the comptroller's office is notified, and anything that's formed through here where there's limited liability will then be subject to Texas franchise tax reporting and potentially tax if sales are over about $2.4 million in Texas. So it's easy to form. You can go to LegalZoom and read up and probably figure it. If you're smart, you can do it yourself. However, if you get into complicated operating agreements, complicated sharing, get a lawyer involved, and we always like to review those because sometimes there are tax and accounting things that we see a little differently. So that usually works best. All right, any questions so far? I'm trying to get us through the lunch and learn quickly, so throwing a lot of stuff out. I wanted to talk very quickly about the sub-S election because it is one way to save some taxes. It does not save any income taxes. A sub-S election can save some Social Security and Medicare tax. And here's why. So you still have limited liability with an S election. You're just electing, especially if you have an LLC, there's another form you file with this, but you're going to elect to become taxed as a small business sub-S corporation. You have 2.5 months after formation for it to be effective at the date of formation, or 2.5 months after the start of a year, so that's March 15th, to file to be effective that whole tax year. There are some late election opportunities, but I don't want to go into those. So if you're considering this, it's best to do it by March 15th. Again, yes, corporate itself does not pay tax generally. It's a flow-through entity, but the profit in this case, the profit that flows through in a K-1 is not subject to self-employment tax. And so that's where the savings opportunity comes in. There are no double taxations on distributions, generally speaking. You pull those out, pull your money out, pull your profits out, you're not going to get taxed again. You're going to pay tax on the difference between revenue and expenses in a given year. Now, the cautions are, there are restrictions on who can own sub-S stock. And in a community property state like Texas, both spouses have to sign the election. And both can't have more than 100 shareholders, but most small businesses, that's fine. I think both have to be U.S. citizens. There's some other restrictions there. There's one class of stock. There are rigid P&L allocations. So this is not a good idea for somebody wanting to have Class A and Class B stock and have different profit and loss distribution percentages. You don't want to do the S election. Now, shareholders and officers must take a reasonable salary. Why is that? Well, the IRS wants there to be Social Security and Medicare paid on this profit or the money that's taken out to a reasonable extent. What's a reasonable salary? Well, that just depends on the circumstances at hand. I mean, a lot of people have used, and I'm not saying this is a magic number, that I'll take 50% of my profits out as a distribution and half of it out as salary. But it needs to be reasonable, what you might reasonably pay somebody else to do your job. The IRS has the ability to come in and change the numbers so to make sure you're paying a reasonable amount of Social Security and Medicare. Basis in an S Corp only increases, and basis can be important if you're going to try and take losses by money you loan to it. So if you guarantee a loan under an S Corp, you're not going to increase basis, but that does happen in partnerships and LLCs. Partners guaranteeing or being responsible for debt increases basis, enabling be able to take loan losses out. So that's another area that's kind of complicated, but I just want to touch on that as a difference. And then something we got to be really aware of. People say, "Oh, I got a C Corp, and it's got a building that's got a basis of $100,000, but it's worth $2 million. I want to sell it and take it out. So I'm going to make an S election, and then that way it'll flow through as a capital gain when I sell it." Okay, there's a thing called a built-in gains tax for C Corps that elect sub S. And basically, that's the difference between the basis and the fair market value at date of election. There's a 21%, whatever the tax rate it is then, and now it's 21%. Tax due is 21% on that by the S Corp, if it's sold within a 5-year period. So this is a potential strategy, but it's a long-term strategy. If I'm thinking I got an issue with my corporation and I'm going to get you need to make the election and plan to wait 5 years to avoid this built-in gains tax. So that's just a quick little something about S elections. Again, they're easy to file, and it can save some taxes. And I think particularly if there's a small business that has other employees, it's a little trickier when it's a single owner doing everything. You say, well, I'm making $100,000 a year. I'm going to take $50,000 out as salary and $50,000 out as distributions. Well, okay, you can do that and probably will get away with it. The IRS may come in and say, well, wait a minute, aren't you worth the whole $100,000 because you're the only one generating the profit? The other thing is it gets tricky if you're trying to pay into retirement plans and all that. So all these things they require people like us to help you through it, make best decisions. Okay, just a couple of special topics I wanted to introduce quickly. One of the things we say to everybody is, I don't care if you're a small business and you think you're really going to help yourself by forming an LLC. I mean, that's true. You should, to limit your liability, but you also need to get good general liability insurance, because if you yourself are negligent, you're going to get sued personally anyway. You're going to sue your LLC and they're going to sue you personally. So have good errors and omissions or general liability insurance for your rentals, for your small business. It's usually not that expensive, and it's just very important to have that to add to your liability limitation arsenal. And again, I wanted to report that all entities with limited liability are subject to Texas franchise tax report. Again, really also, as we've talked about in an earlier session, that new BOIC, the federal, you've got to tell who the owners are in your LLCs or LPs or corporations. With Texas this year, has to be done this year. I mean, with the federals. I wanted to just introduce a Texas Series LLC as a concept. You can form a Series LLC in Texas, which is one formation with multiple series under it. And for people especially people do this with rent property, you don't have to form a new LLC every time you put a rent property in there. You have to keep the books and records separate for each. That doesn't mean separate accounting programs or even checking accounts, as long as you can identify what's inside that series. You title the property inside that series LLC. So you have Series 1 has a rental property, Series 2 has a rental property, Series 3 has a rental property. Each one of these is treated like a separate LLC, and there's a limitation of liability. So if something happens in Series 3, it can't pierce and get to stuff at Series 1. So that's something to do, that you just have the expense of forming one LLC, and you have 10 rental properties in there with different series, but you do have to manage it properly. Again, we talk about doing business as or an assumed name. If you want to operate under a different name, and again, if you're a sole proprietor, go to the local courthouse. If you're going to do it with anything else, you have to file an assumed name certificate with Texas. I think it's $25. It's not much. It needs to be a unique name, and so you'll find if it's available. I think they usually look at the first 2 words in a name to see if they think that makes it unique, and that it's active and in business. You can grab it if somebody's let it lapse. But in some cases, we've had to ask for permission to use a name if it was a related entity, and there's a form you get them to sign. Another thing I wanted to talk about just real quickly is, should spouses be partners or members? And there are different situations in complex areas where, yes, it's best to do that, especially if they're estate planning considerations. Generally, though, we say Texas is a community property state, and each spouse owns 50% of the other spouses in a general sense, unless you worked very hard to keep your assets separate, if you commingled in any way. So if you have one business and you both work in there, why do a partnership return? Just put it in one spouse's name, and that way you've got a disregarded entity. You put it on your tax return. So, that's because of the community property laws in Texas. You may want to talk to, if you have a very complicated situation. But in general, so I'm saying this is generally, you probably don't want to go to the expense of filing a partnership return when it's going to come on a joint tax return under one person's Social Security number. But there are some issues too sometimes where both spouses want credit for Social Security paid into their Social Security account. Well, even there, one spouse could work for the business and one spouse own it. You get to the same place. So anyway, those are things we counsel with people about when they have those kind of questions. All right, that's an introduction there. Anybody got any questions? I'm going to see if I can get back to this. I don't know if there are any chats up here to look at in the Zoom. I'll stop sharing and see if there's any. I don't see anybody have any questions at all before I sign off. Well, okay, I hope that's been somewhat helpful, and hope you have a great week, and we'll be back in a couple weeks.